$3.3 trillion of chip value, gone. Inflation came in cold. The Fed backed off. And chips crashed anyway. The semiconductor index is now in a bear market. What did it? Wasn't a rate decision, an earnings miss, or a war. It was a model release out of Beijing. Last Saturday I gave you 3 calls. 2 hit. The one I got wrong is why this week matters. I was right that the tape would crack, and completely wrong about what would crack it. Let's grade it in public. I'm Big Z. This is your weekly brief for the week of July 13th. 3 calls on the board. 2 were clean. Call 1, 7,500 is the line on the S&P, lose it, and the chips that just came back give it up again. It closed at 74.57, and the semiconductor ETF fell 10.2%. Hit, including the conditional. Call 2, credit passed 3% and we stop calling this rotation. It finished at 2.71, 2 basis points wider. In a week semis lost 10. Still rotation. Hit. Now the one I got wrong, because it's the whole episode. I said a hot inflation print was the real risk, that it would hand the hike camp the microphone and crack this tape. June inflation printed 3.5% against 3.8 expected, the coolest read in months. The hike trade collapsed. And the market fell anyway. Right about the outcome, wrong about the mechanism. That's not a small miss. It means the thing driving this market is no longer the Federal. So what is it? Here's the damage, and notice how uneven it is. The S&P fell 1.5%, closing below its 50-day average for the first time since April. The Nasdaq 100 dropped 4.1. The Dow, less than 1. And the Russell 2000, small caps, supposedly the fragile ones, fell 0.5%. Read that spread again. The more large-cap technology an index held, the worse it did. This wasn't a market sell-off. It was a sector sell-off wearing a market's clothes. VIX jumped 25% to 18.8, awake, nowhere near panic. 5 of 11 sectors finished green this week. Let that sit. Energy led, up 4.7%, as crude rose 13.4 on escalating US-Iran tensions and confirmed crude transit through the Strait of Hormuz fell 62%. Real estate added 2.2 on the soft inflation print. Staples up 1.3, financials up 1, healthcare up 0.2. Technology? Down 5.5. That's the worst sector by a mile, more than triple the next worst decline. That's the cleanest rotation signature you'll see all year. Money didn't leave. It moved, out of the AI infrastructure trade and into everything else. So what actually happened? On Thursday, Chinese startup Moonshot AI released a model called Kimi K3, 2.8 trillion parameters, the largest open-weight model in the world, with independent benchmarks putting it behind only the very top US systems. And here's what matters, the weights aren't even out yet. Moonshot promised them by July 27th. The market didn't sell on a product. It sold on the promise of a download link. But be honest about the sequence. Chips were already cracking before Thursday, the 3.3 trillion has been bleeding since June 22nd, and the semis ETF has now fallen in 3 of the last 4 weeks. K3 didn't start this. It did something worse, it gave a vague valuation worry a specific, dated, falsifiable form. That's what turns a drift into a repricing. Because if a near-frontier model can be downloaded and run by anyone, the assumption every semiconductor multiple rests on, that compute stays scarce and demand compounds forever, becomes a question. And here's the image that captures it. Apple briefly passed Nvidia as the world's most valuable company, first time since May 2025. Capital stepping away from who builds intelligence, toward who sells it. If you want the full teardown of the AI compute chain, and who survives when models get cheap, that deep dive is coming. Subscribe so you don't miss it. Here's the number that tells you this wasn't panic, it was surgery. Marvel fell 20% on the week. It went into that week up 122% for the year. Micron, down 13. AMD, 11. Taiwan Semi, 8. Broadcom, 7. And Nvidia? Down 3.9. The most obvious AI stock on Earth was one of the least damaged. That's not a bug in the story, it is the story. The market marked down the second derivative, the high beta names that need demand to keep accelerating, and left the franchise alone. Elsewhere, Chevron up 6.2, Exxon 6.1 on the oil bid. Netflix fell 6, down 12 at Friday's worst, after earnings came in fine and guidance came in slightly light. In this tape, fine gets punished. Now the check that tells you whether to worry. The equal weight S&P fell 0.4%. The cap-weighted S&P fell 1.5. Equal weight outperformed by 1.11 percentage points. The average stock had a nearly flat week while the giants dragged the index down. 64% of the S&P still trades above its 50-day average. New 52-week lows never exceeded 6 names in a day all week, and on Thursday, 46 stocks hit new highs against exactly one new low. There's no capitulation signature anywhere in this data. Underneath a bear market in semiconductors, the median stock is fine. That's a repricing of one theme, not a market breaking down. And this is how you know it was the model, not the oil shock or the Federal. A macro shock doesn't leave energy up 4.7 and real estate up 2.2 while it's happening. It doesn't get the cap-weighted index and spare the equal weight one. Whatever hit this market could only reach the things priced on compute scarcity, and it reached every single one of them. 3 signals the mainstream recap skipped, and the first is a promise I made you 3 weeks ago. 1. The uranium gap finally closed. For 3 straight briefs I flagged that uranium spot sat flat near $85 while uranium equities ripped, and said I'd keep flagging it until one side blinked. This week it blinked, and it was the equities. The uranium ETF fell 9.9%, 19.4 over 5 weeks. Spot uranium? 85.45. Unchanged. Cameco now sits 37% below its high. That was never a commodity move. It was a multiple move, and the multiple just left. 2. Ocean freight broke in 2 places at once. The Baltic Dry Index fell 3.1% on Friday alone and more than 6 on the week. Container rates fell too. Dry bulk and containers have unrelated demand drivers, both rolling over the same weak points at vessel supply, not demand collapse. And the Baltic is still up 34% year-on-year, peak season fading off a strong base, not a cycle turning. 3. Natural gas closed at $2.92, storage 6.4% above the 5-year average, in peak cooling season, production climbing. Every AI infrastructure pitch says data centers force a structural bid for gas. The gas curve doesn't believe it. The bottleneck isn't the fuel, it's the grid equipment. The data was good and the earnings were records, and none of it mattered. That's the tell. Producer prices fell, jobless claims came in at 208,000, and consumer sentiment hit a 5-month high. The Philadelphia Fed Manufacturing Index printed 41.4 against 13 expected, the highest since November 2021. Then Wall Street had the best quarter of its life. The 5 big banks reporting Tuesday cleared $49 billion in combined profit, up 39%. Goldman posted its best quarter ever, equities trading revenue up 72%, an all-time Wall Street record. The tape's verdict? Goldman jumped 9% on the day and finished the week up less than 1. Citigroup beat every estimate and fell 8. Morgan Stanley set a revenue record and fell 3. Meanwhile, markets now price an 87% chance the Fed holds this month, 13% chance of a hike, and 0 chance of a cut. Good data, record profits, no rate threat, and the market still fell. When fundamentals stop moving prices, something bigger is being repriced. Here's what decides whether this is a pause or a turn. Wednesday is the whole week. Alphabet and Tesla report after the close, alongside Texas Instruments and IBM. Thursday brings Intel. Texas Instruments and Intel land right in the wound. They'll tell you whether this drawdown is about sentiment or about actual orders. Friday brings flash PMI readings. The Fed decides July 28th and 29th, just outside the window. Now your triggers, for levels that decide it. On the S&P, the 50-day average is now overhead resistance instead of support. Reclaim it, and this was a 2-day scare. Fail there and the next real test is the 200-day. On credit, 2.71, past 3%, and this stops being rotation and starts being risk. On the chips, the semiconductor index sits 20% below its June record, and the tell for a real bottom is simple: it stops making lower lows on bad news. On the AI trade, Moonshot said the weights land by July 27th. If they show up and independent testing confirms the benchmarks, this repricing has a second leg. If they slip, a lot of this week gets bought back. One cross-market note. The most consequential market event of the week wasn't American. A Chinese lab put out a model it hasn't even released yet, and it erased $3.3 trillion from global chip stocks. Meanwhile, Middle East supply risk pushed crude up 13.4% and made energy the best sector on the board. Two shocks, both from outside the United States, both landing harder than a soft inflation print. The bottom line. The framework held again, the level broke and chips followed, credit stayed calm and it stayed rotation. But my third call missed, and the miss is the lesson. This market has stopped trading the Fed and started trading whether intelligence stays expensive. Inflation came in cold and it didn't matter. That's the regime change. Watch the level, watch the spread, and watch for that download link. That's your weekly brief. I'm Big Z, follow me, see you in the next deep dive.